Warren Buffett, the legendary investor and CEO of Berkshire Hathaway, has made headlines with his notable market actions, particularly his recent stock sales. Known for his value investing approach, Buffett typically seeks out undervalued companies with strong fundamentals, holding on to them for the long term. However, his recent decisions to divest from certain stocks have sparked curiosity and speculation among investors and market analysts alike. These moves not only reflect his current market outlook, but also provide insights into broader economic trends. Warren Buffett's current cash holdings have garnered significant attention, particularly as they stand in stark contrast to his positions during previous financial crises. Historically, Buffett has maintained a disciplined approach to cash reserves, often deploying capital into undervalued assets when opportunities arise. However, in recent times, his cash reserves have reached unprecedented levels, raising questions about his strategy and the implications for the market. Holding a substantial cash position in the current environment suggests a cautious outlook, as Buffett appears to be preparing for potential market downturns. This strategy allows him the flexibility to act swiftly when attractive investment opportunities present themselves, especially in a volatile market characterized by uncertainty. The significance of these increased cash reserves cannot be understated. They reflect not only Buffett's confidence in his ability to identify value, but also a prudent approach to risk.
Don't forget to subscribe, like us, turn on the notification bell, and comment.
Risk management. In a landscape where many investors are heavily invested in equities, Buffett's cash strategy serves as a reminder of the importance of liquidity. By maintaining a robust cash position, he positions himself to capitalize on market corrections, which historically have provided some of the best buying opportunities. Furthermore, this approach underscores a broader trend among investors who may be reevaluating their portfolios in light of economic fluctuations. As we analyze Buffett's cash holdings, it becomes clear that his strategy is not merely about waiting for the right moment, but also about safeguarding against potential downturns. This perspective invites viewers to consider the merits of liquidity in their own investment strategies, particularly in uncertain times. Ultimately, Buffett's cash reserves highlight a blend of caution and opportunity, reinforcing the timeless wisdom of being prepared for market shifts. Warren Buffett's recent stock selling activities, particularly concerning his stakes in Apple and Bank of America, have sparked considerable interest and analysis among investors. Buffett, known for his long-term investment philosophy, has made headlines by reducing his holdings in these two significant positions. The extent of these sales is noteworthy. While he remains a substantial shareholder in both companies, the decision to sell portions of these stocks raises questions about his rationale.
Don't forget to subscribe, like us, turn on the notification bell, and comment.
Possible explanation for these moves could be a strategic reallocation of capital, allowing him to maintain liquidity and flexibility in a fluctuating market. Historically, Buffett has demonstrated a willingness to sell stocks when he believes they have reached their intrinsic value, or when he identifies more attractive investment opportunities elsewhere. This behavior is not entirely new. In fact, Buffett has a track record of adjusting his portfolio in response to changing market conditions and economic forecasts. By analyzing his recent sales, we can see how they fit into a broader context of his investment strategy, which emphasizes adaptability and prudence. The impact of these sales on his overall investment strategy is significant, as they reflect a calculated approach to risk management. By trimming his positions in high-profile companies like Apple and Bank of America, Buffett may be signaling a cautious outlook on the tech sector and the banking industry amid economic uncertainties. This strategic maneuvering invites investors to consider the importance of portfolio diversification and the potential need to reassess their own holdings in light of market trends. Ultimately, Buffett's recent stock sales serve as a reminder of the dynamic nature of investing and the necessity of remaining vigilant in an ever-changing financial landscape. As we explore key market valuation indicators that suggest a potential crash, it's essential to examine metrics like the S&P 500 price-to-earnings P/E ratio and Buffett's
Don't forget to subscribe, like us, turn on the notification bell, and comment.
indicator, which is the market capitalization to GDP ratio. The S&P 500 P/E ratio is significant because it provides insight into how much investors are willing to pay for a dollar of earnings, reflecting overall market sentiment. Currently, the S&P 500 PE ratio is elevated compared to historical averages, indicating that stocks may be overvalued. Similarly, Buffett's indicator, which compares the total market capitalization of the stock market to the country's GDP, also points to potential overvaluation. Historically, this ratio has hovered around 75% to 90%, but recent figures have soared well above these levels, suggesting that the market may be in bubble territory. When current valuations are compared to historical averages, it becomes evident that the market is trading at a premium, raising concerns about sustainability. Such overvaluation can have significant implications for investors, as it often precedes market corrections or crashes. When prices are inflated, the risk of a sharp decline increases, leading to potential losses for those heavily invested in. Investors should be cautious, as overvalued markets can create a false sense of security, luring them into complacency. Understanding these valuation indicators is crucial for making informed investment decisions. As we navigate this landscape, it's vital to remain vigilant and consider the potential risks associated with high valuations. By recognizing the signs of overvaluation, investors can better position themselves to protect their portfolios and capitalize on opportunities that may arise during market corrections. Ultimately, awareness of these key indicators can help
Don't forget to subscribe, like us, turn on the notification bell, and comment.
investors navigate the complexities of the market and make strategic choices in uncertain times. The relationship between interest rates and stock prices is a critical aspect of market dynamics, and Warren Buffett has often described interest rates as a gravitational force influencing asset prices. According to Buffett, when interest rates are low, borrowing costs decrease, making it cheaper for companies to finance growth and for consumers to spend, which can drive stock prices higher. Conversely, rising interest rates can exert downward pressure on stock prices as the cost of borrowing increases, potentially slowing economic growth and reducing corporate profits. Recently, we have witnessed a trend of fluctuating interest rates, with central banks adjusting rates in response to inflationary pressures and economic recovery efforts. As rates have begun to rise, concerns have emerged regarding their potential impact on the stock market. Higher interest rates can lead to increased discount rates applied to future cash flows, making stocks less attractive compared to fixed income investments. This shift can result in a reevaluation of stock valuations, particularly for growth-oriented companies that rely heavily on future earnings. Buffett's investment decisions often reflect his understanding of these dynamics. For instance, in an environment of rising interest rates, he may choose to pivot towards more stable, dividend-paying stocks that can provide consistent returns rather than high-growth stocks that may be more sensitive to rate changes.
Don't forget to subscribe, like us, turn on the notification bell, and comment.
Additionally, Buffett's focus on companies with strong fundamentals becomes even more pronounced during periods of rising rates as he seeks to mitigate risk and ensure that his investments can withstand economic fluctuations. By connecting interest rate changes to his investment strategy, Buffett exemplifies the importance of adapting to macroeconomic conditions, reminding investors to remain vigilant and responsive to the broader economic landscape. The yield curve has long been regarded as a reliable predictor of recessions and market crashes, with its historical accuracy lending weight to its significance in economic forecasting. Typically, the yield curve plots the interest rates of bonds with different maturities, and under normal circumstances, longer-term bonds yield higher returns than short-term ones. However, when the yield curve inverts, meaning short-term rates exceed long-term rates, it has often signaled an impending economic downturn. Historically, this inversion has preceded nearly every recession in the past several decades, making it a critical tool for investors and economists alike. Currently, the state of the yield curve is drawing attention, as recent fluctuations have raised concerns about potential economic slowdowns. An inverted yield curve has emerged in certain segments, suggesting that investors are anticipating weaker growth ahead. This situation implies that market participants may be seeking the safety of long-term bonds, driving their yields down, while short-term rates remain elevated due to central bank policies. The correlation between yield curve inversions and market downturns is particularly noteworthy. Past instances of inversion have often been followed by significant market corrections. For example, the yield curve inverted before the 2008 financial crisis and the dot-com bubble burst, highlighting its predictive power. As investors monitor the yield curve, they should consider its implications for their portfolios. An inverted yield curve may prompt a reassessment of risk exposure and
Don't forget to subscribe, like us, turn on the notification bell, and comment.
asset allocation strategies, as it often signals a shift in economic sentiment. Understanding the yield curve's historical context and current state can provide valuable insights into potential market movements, allowing investors to make informed decisions in an uncertain economic environment. Ultimately, the yield curve remains a vital indicator for anticipating recessions and preparing for potential market challenges. Warren Buffett's long-term investment strategies and advice have become foundational principles for investors seeking to build wealth over time. One of his key teachings emphasizes the importance of holding stocks rather than succumbing to the temptation of cash. Buffett often argues that cash is a poor long-term investment as it fails to generate meaningful returns and can erode purchasing power due to inflation. Instead, he advocates for investing in high-quality companies with strong fundamentals, allowing investors to benefit from compounding returns over time. Central to Buffett's philosophy is the importance of patience and long-term thinking. He famously advises investors to adopt a mindset akin to that of a business owner, focusing on the intrinsic value of a company rather than short-term market fluctuations. This approach encourages investors to remain committed to their investments, even during periods of volatility, as the true value of a well-chosen stock often becomes apparent only over the long haul. In the context of current market conditions, Buffett's philosophy is particularly relevant. With rising interest rates and economic uncertainties, many investors may feel inclined to react impulsively to market movements. However, Buffett's teachings remind us that maintaining a long-term perspective can be a powerful tool for navigating turbulent times. By focusing on quality investments and resisting the urge to chase short-term gains, investors can position themselves for success. Moreover, Buffett's emphasis on understanding the businesses behind the stocks reinforces the need for thorough research and analysis, especially in a complex market environment. Ultimately, Buffett's long-term investment strategies serve as a guiding light for investors, encouraging them to remain disciplined, patient, and focused on the bigger picture, even amidst the noise of daily market fluctuations. Thank you for joining us, and we hope to see you in our next video.